The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois. I congratulate my friend from Illinois for his position as ranking member of the subcommittee. I look forward to working with him in a bipartisan way. Dr. Foster, for 4 minutes for an opening statement.
Well, thank you, and congratulations yourself, Chair Barr. It has been, for me, an interesting journey. I took office for the first time in March of 2008 and was down in the front rows there during the financial crisis. I was reading Kindleberger and in the weeks before Lehman fell, and decided I would actually finish reading it over the weekend after that happened. And so I think it's the most important thing we need to have in this committee generally, in this subcommittee in particular, is a complete and correct understanding of history. Because, I will be distributing a picture that sort of encapsulates that. This is simply a history of bank failures in the United States from 1864 until the financial crisis, basically. And it's interesting to look at the general picture of this, that you see, first off, that you see prior to the 1930s, bank failures were very common. You know, they just happened almost on a weekly basis. And then there was a crescendo of them in the 1920s and 1930s. And then we passed the FDIC bill and Glass-Steagall and so on, and boom, they went to zero for about 40 years, near zero for 40 years. And then we had a burst of deregulation in the 1980s, and were rewarded by the savings and loan crisis, which is not something that's on a lot of our consciousness at this point. But in fact, the taxpayer paid something like 1.7% of GDP, dead loss to the taxpayers because of the savings and loan crisis, which was not a failure of a few giant banks. It was a failure of thousands of small banks that were, in retrospect, underregulated and got on the wrong side of some interest rate bets and some rather corrupt practices in some case. And then, so then we put that behind us, and then had another wave of deregulation in the early 2000s, and of course paid the price tremendously in the financial collapse. And so what our goal, our first goal, our prime directive in this subcommittee is we do not want to be having hearings on the next wave of bank failures and collapses. And we have to understand the importance of proper regulation in that. The second thing is just generally the merit of regulation, and I will also be distributing this table. This is a table that I made, probably a decade ago, almost maybe 2015, I think. It was simply a list of all the failures, the giant failures, bailouts and bankruptcies of giant businesses, most of them financial businesses. And at the time I made this, I don't think the list has changed significantly. You know, at the top, of course, it's Fannie and Freddie, Lehman Brothers, Washington Mutual. These are just sorted by the assets of failure. And behind every one of these failures is grief for thousands of American families. You know, the employees of Enron suffered tremendously because there was not proper regulation of Enron. And just you go down this list, Continental Illinois Bank and Trust is still remembered in my state of Illinois as something that, interestingly, of the top 16 largest firms by assets at failure, every one of them happened under Republican watch. And I think that's significant. So we have to be careful not to just follow the traditional, partisan split on this and repeat mistakes that were important in the past, because when giant businesses fail, it's not just Wall Street that suffers. It's ordinary families, and we have to understand that. Anyway, there's also a lot of issues. I want to thank the witnesses for their written testimony, because it represents the full spread of issues that we have been and will be and should be discussing on this. And I just want to touch on one thing, preemption, that there's a long list of issues that, you know, some people argue for a federal floor, a federal ceiling, a federal standard. Other institutions love the idea that we have 50 different standards because they enjoy it as a barrier to entry to new competitors. And so the idea that I want to throw out there as an area of potential compromise on this is the idea that any group of representing 20% of the states should be able to get together and adopt a common standard, so that new entries would only have a handful of standards instead of 50 different or a single one-size-fits-all. Anyway, thank you, Mr. Chair, and